Hello, everyone. This is a KBRA podcast reviewing a recent research report that Peter Scherer and myself, Ethan Heisler, wrote on Puerto Rico and the Puerto Rican banks. I have with me Karen Daly, who heads up the Public Finance Department, and Peter Scherer, who works for Karen as one of the analysts, and of course myself. So what I think we'd like to do today is to go over some of the salient points of the report and highlight that. So I'm going to ask Karen to take it away from there.
Thank you, Ethan. Peter, we've been hearing about deteriorating economic conditions in Puerto Rico and the severe negative effect that the hurricane events of 2017 have had. What are your thoughts and takeaways about that?
Well, there's an interesting history here. Puerto Rico's economy had a remarkable run in the 3 decades running up to 2004. Federal tax provisions granting corporations a full U.S. federal income tax exemption for profits originating on the island supported a period of strong investment and expansion of good-paying jobs. But the incentives were phased out by the U.S. Congress between 1996 and 2006, and many large corporations responded by downsizing and leaving. The Commonwealth responded to the phase-out by increasing government hiring and spending, which supported continued growth until about 2004. But these incentives weren't sustainable, and the island's economy has now contracted for 14 consecutive years. The severe hurricane events in 2017 that you mentioned made matters worse. They damaged already vulnerable infrastructure and left nearly half of the island's population without power for more than 90 days. A large decline in economic activity after the storms has subsequently moderated, and there's some reason to be optimistic that an inflow of insurance payouts and federal disaster recovery funds will stimulate the island's economy. Some data points, tracked by the Commonwealth's Economic Development Bank, signal reason for optimism that a recovery is taking place. But in our opinion, the leading indicators remain mixed, and it's not clear whether Puerto Rico's economy has finally stabilized from the phase-out of the tax provisions.
Thanks, Peter. This is Ethan Heisler again. I guess to follow up on what Peter was saying, the big takeaways in the report about the banks that remain in Puerto Rico is that having gone through 14 years of recession, having gone through 2 back-to-back hurricanes, the 3 remaining institutions on the island, through domestic institutions, which are Popular, First Bank Puerto Rico, and Oriental, have actually prospered and done quite well, particularly over the last couple of years in the midst of and since the hurricanes. I think that when we step back and think about why are these 3 institutions rated below investment grade, the argument seems to always come back not so much to the quantitative or the qualitative features of these institutions, but rather the overall environment in which they operate. But in our view, the overall operating environment is their core strength. They have demonstrated through 14 years that they can survive and prosper and make money. They have built up considerably stronger capital base than they've had in the past. And moreover, the sins or the mistakes that they made in the past, if you think about that, one of the key problems that they had was that they tried to diversify away from the Puerto Rican economy in the midst of this, or the early days of this recession. Unfortunately, that decision brought them smack dab right into the middle of the financial crisis. So expanding in Florida in 2006 was probably not the greatest timing for them. They've paid heavily for that. They've written off quite a bit. I would say at this stage you're looking at institutions that, having weathered this storm, are prepared to continue to grow and have consolidated all the other banks on the island. For this reason, we think that the ratings for Popular, for First Bank Puerto Rico, and for Oriental need to be rethought. The major rating agencies continue to hold them below investment grade. I can't comment as to what the actual ratings for these institutions should be, but I do think the rationale of what we've been operating on, why these banks are below investment grade, need to be reconsidered, and the piece was really designed to go ahead and get people to think about that. So with that, let me turn that back to Karen. Karen, any closing remarks?
Yes, we continue to monitor the island's Title III debt restructuring proceedings, relevant court decisions, which we've written extensively about, and the general economic indices of the island. And we'll be writing about that on a go-forward basis.
Karen, can I ask you one question? I heard Peter mention this about the weak outlook for the Commonwealth, but given the fact that Congress has now approved disaster aid for the island, do you see any potential uptick as a result of that?
It's certainly a possibility, and that's something that we will be monitoring.
Very good. Well, anyway, thank you very much for listening. This is Ethan Heisler, Karen Daly, and Peter Scherer. We appreciate your attention.